Hi there, welcome to the video. In this video, I'm going to be talking about quantitative easing and its impact, so the effects of quantitative easing. Specifically, I'm talking about quantitative easing as monetary policy following the global financial crisis. Okay, so let's kick off and look at the first slide, which shows the impact of what's been described as the new normal of central bank policies. New normal, broadly speaking, is defined, I suppose, by quantitative easing and also by low interest rates. So low interest rates and central banks creating liquidity for the markets is really what is the definition of the new normal of central bank policies, but is also a definition of the unconventional monetary policies. Conventional policies would be related to the manipulation or the utilization of inflation, of interest rates. But once you've reduced interest rates down to what's known as the zero lower bound, or whatever it might be perceived as being the zero lower bound. I mean, as it's zero, I think the interest rate in Japan currently is 0.001%. What do you do next? And the response, once the interest rate actions had been undertaken, the response of central banks was to try and increase the amount of liquidity into the banking system. Now, we'll need to talk about how that happens, but first of all, let's just and why that happens. But first of all, let's just look at this particular graph, and this graph shows the increase in the size of balance sheets of the central banks. Okay. Top one, the light blue one's the Bank of England, and then you've got the European Central Bank, and then underneath them is the Bank of Japan, and then you've got the US Fed. Okay, so basically the three big ones, the European, the Bank of Japan, and the Fed, have grown their balance sheets by around about the same sort of amount in terms of growth against GDP. But the Bank of England is much smaller, the economy is much smaller, and that's what you would expect. But what you can see is you can see a growth of the size of the balance sheets from 2011 up to 2016, and that is as a consequence of the quantitative easing policies that the banks have engaged in, which really is to swap liquidity for assets. Now, they've done that in different ways, and we'll talk about that in a little bit. But the net impact has been that the size of the balance sheets of the central banks has grown dramatically over the period of quantitative easing and then the new normal of central bank policies. So quantitative easing, let's just take a back up a little bit and sort of talk about what it is. First is that it's often referred to as printing money. Well, nobody's actually printing money. We're not talking about base money in terms of coins and notes being printed and distributed around the economy. Is that what we're talking about is a change in the assets and the liabilities of commercial banks, financial intermediaries, and the central bank. The term's credited to Werner, Richard Werner, who we've met once before, who was a banker is a banker and an economist in Japan at the time of the collapse of the Japanese bubble in 1989, 1990, in the early 1990s. He is a fluent Japanese speaker and was advising the Bank of Japan at the time. And the literal Japanese translation of what he was advising them is quantitative easing, which is a strange and peculiar phrase, but it's not that new, in other words. So, you know, the Bank of Japan effectively started to engage with quantitative easing in the early 1990s. So it's been around for a while as an innovation. And there are different ways that you can go around quantitative easing. In essence, what you're trying to do, or the goal of it, is to use monetary policy or to stimulate economy through the supply of liquidity into the banking system. Okay. First off, the way that you might do it, or the first method of trying to stimulate the economy would be by lowering the interest rates. Effectively, as if you're lowering the interest rates, is that you're lowering the cost of money, which makes it more favorable for people to borrow and to spend, and that would have an impact upon productive purposes, providing that the money is being spent on things that are counted in GDP. If it's not being spent on those, like such as it's being spent on speculation, then it'll have no impact upon GDP at all. Another way in which the central bank can quantitatively ease is by increasing the reserves. Now, it can increase reserves in one of two ways, is that it can make direct loans to the commercial banks, the high street banks, or other intermediary bodies, or it can credit the accounts that are held at the central bank, which is the reserve accounts. Now, that will be done in the form of a loan. So in both cases, they're loans, but one would be a sort of central bank money that would go into the assets of the commercial banks in terms of cash, if you like, although it would be credit. And the other way would be to stimulate the reserves, which is the accounts that all commercial banks hold with the central bank. The reason that they do that is that then one is that there is a reserve ratio that needs to be held, so that if the reserve ratio is 10%, so 10% of all loans, it needs to be held with the central bank, and that's the kind of like the stabilizer, the protection of the banking system. And then the other reason is that the bank is the payment system. The central bank is the payment system. So if people have got bank accounts with different banks, and then there is a transfer of money that's across, it's done via the central bank and the shifting of reserves from the central bank, one account from one bank to the account of another bank, but only within the reserve system of the central bank. I hope that's clear. So all transactions of the banking system are aggregated up, and then they are settled out at the end of the day via the reserves of the central banking system. So if Barclays owes the Royal Bank of Scotland 500 million, is that will be a transfer at the end of the day for 500 million from the reserve accounts of one bank to the reserve account to the other one. So by increasing the levels of reserves, is that you can stimulate banking activity, which can stimulate lending, stimulate productive capacity, and so on and so forth. So that's one way where you can do it, is you can increase reserves directly. Another way that you could do it is to buy assets. So these are company assets, but these would be company assets that could be banking assets, but they could also be assets of private sector firms, or it could be other financial intermediaries. So typically, central bank would buy bonds, and then you would, in effect, is that there's an exchange, therefore, of the bond for the bond would transfer across to the central bank, and the central bank would credit the account of the seller of the bond. So if pension fund X sells £1 million worth of bonds to the central bank would therefore credit the account of the pension fund with £1 million. So it's basically a transfer of the assets for liquidity. But also is that central banks can buy up bad debts. So at the time of the global financial crisis, there was quite a considerable amount of mortgage-backed securities that were failing, and so the bank stepped in to buy those off. So you've got a transfer, therefore, of bad debt off the balance sheet of the originators for central bank money. So the bad debts would therefore sit onto the central bank's balance sheets as a consequence. And I think what's quite interesting in that one is that the value that was paid, or the amount that was paid for the bad debts, and how they were valued at the time. And they were valued kind of at the time of purchase on what's known as a mark-to-market basis, i.e. you agree between each of you as to what the assets are worth. But in some cases is that the bad debts were bought at the original value, not the depreciated value, which means that in effect, I suppose, the central bank is taking an increased amount of risk onto its own balance sheet. Similarly, central banks would buy commercial paper, and a lot of this was wrapped up in a number of different activities that were given acronyms, one of which is TARP, which was a Troubled Asset Relief Programme, which was particularly prominent within the European Central Bank, when Mario Draghi committed to do whatever it literally committed, and the quote is that the central bank will do whatever it takes, and they bought all sorts of troubled assets off the banks of Europe, who actually, in proportion to the amount of assets that were on the balance sheets of American banks, the European banks were much more over leveraged and had multiples in terms of size of GDP on their balance sheet. So as an example, the Royal Bank of Scotland had got more assets, or the size of its balance sheet, the assets on its balance sheet was larger than the GDP of UK, and that was not untypical across the European banking system. And then, in fact, banks in Germany and other areas France were very, very highly had got huge balance sheets. So the central bank, in effect, would be buying those troubled assets off the banks and off companies, and then crediting their accounts with money, so by way of putting money into the banking system. And then finally, central banks could buy government bonds, and the way that they did this was by setting up an off-balance sheet vehicle, really, called the APP, provided them with a loan, and then the APB bought government bonds off pension funds or other financial intermediaries. So, as I've said before, is that bonds, broadly speaking, are bought by through auction. Is that the government issues the bonds, or the central government issues the bonds. They're bought up in the auction, and then the central bank would step in order to be able would then step in and buy the bonds back off the auction, the people who are successful in the auction. You can see in that instance, however, is that broadly speaking, is what you're doing is that the net increase in terms of the amount of money that's gone into the system is zero. In the cash that's been used to buy the bonds is just being transferred, is being replaced by central bank money via the APP. So the net process is, in terms of credit creation or credit easing, and as we saw in an earlier video, it's credit easing that is it's the credit creation which is the fundamental issue in terms of driving the economy. And so by buying government bonds off non-banks, but also just swapping central bank money for financial intermediaries money, is not having an impact upon credit creation. So really, it's those practices that were direct in stimulating credit creation are the ones that were most effective. Although even that is questionable. But in the case of the Fed, where they bought quite a lot of assets off companies, banks and non-bank financial intermediaries, it did stimulate levels of credit, and there was some growth, much more so than in other countries. But some empirical work that's been done by a colleague of mine, Ismail Erturk, casts some doubt upon that, and we'll look at that in a minute. But broadly speaking, is that quantitative easing is a way of providing liquidity into the financial sector in order to try and stimulate growth. And they do it in one of four ways: reducing interest rates, but when interest rates are so flat, they engage in more monetary mechanisms, or by increasing the reserves, either cash held at bank or by the reserves held by the central bank, buying assets, and by buying government bonds and crediting the accounts accordingly. But the most important thing here is that it's not just the liquidity or the money supply that needs to grow, it's how it's used and how credit, whether or not credit is actually, the use of credit and the take-up of credit is actually increased within the economy. And this is the research that I'm referring to. Now, what you can see on here, okay, first off, everything is balanced out or based out to 100, okay, but you've got the red line is the S&P 500, the top line is GDP growth, the top purple line, and then the grey line underneath is the amount of investment. Now, the quantitative easing is engaged, or is the policy of quantitative easing, monetary policy, is being used to try and stimulate the economy after the credit crisis. And there is quite a considerable amount of money that has been poured into the US system through different tranches of QE, QE1, QE2, and QE3, as you can see on the graph here. This line shows that this is the baseline of 100. Okay, so everything's balanced back or based back to 100. The growth in GDP is that, which is probably, I don't know, probably around about 2 to 3%. But given the amount of money that the Fed had put into the economy, is that, you know, you'd have to suggest or question whether or not that's an effective use of the amount of money that's been put in. But more importantly is that the amount of firm investment, the amount that, despite the fact that borrowing is extremely accommodative, interest rates are very low, and there is a lot of liquidity in the system, is that companies throughout the US, is that there is a fall in the amount of investment from 2007 through to 2014. Okay, so the money is not being used for productive purposes. But if you therefore look at the S&P 500, is that there is a considerable growth in stock markets. Okay, so I mean, basically is that financialized firms are going to try and maximize their share price and are not likely to invest long term in an economy that's effectively stagnant. And I think also what's interesting is that if you look at the timings of QE1, and then there's a lag, and then there's a growth in share price activity, same within QE2, and the same within QE3, is that by and large is that, and this is only, it's not, you wouldn't describe it as necessarily being causal, but one of the things that you might do is that you might say, well, there's an interesting sort of correlation there that's worth digging into. So, you know, can we find out some more information there, or more data there that might explain what's going on? Well, if we follow the story through, is that we can first off look at the composition of the commercial bank balance sheets between 2007 and 2015. And what we can see here is, I mean, in some respects, this is a spectacularly uninteresting graph, that nothing seems to be happening. But the blue line at the top is real estate loans, and banks like to lend on real estate. We know that because it's very profitable. But real estate loans, mortgages have effectively declined quite a lot. Corporate loans, which are the green line, are pretty flat or static. about the same as where they were in 2007. And then consumer loans have grown 2010 to taper off by the time that you get through to 2015 again. So they're pretty, just a little bit up on where they were in 2007, but not significantly. But the real change is in the cash that's being held at the bank. And that's the purple line, is that if you look at the cash that's being held, that's in 2007 was around about 4% and has gone up to around about 17% by 2011. So it's quite a dramatic increase there. So one of the things that might be concluded from this is that the liquidity production and of attempting to increase the reserves of the banks was successful, but the money, the cash, effectively stayed on the balance sheets. Now that's not strictly true, because that's a dynamic asset, is that cash will be used and brought back into the bank very, very quickly. So cash can go out on investments and cash will come back. And this corresponds, I think, back to Minsky's kind of idea of a conservative state of the economy following a crisis, is that why would banks loan money to a firm on the long term? So if somebody came to the bank and said, look, I've got a really good idea for a business venture. I'm going to open a productive plant in the Philippines. Here's my cash flow and all my figures and my business plan. And the bank says, yeah, that's great. When do we get our money back? And they say, well, 15, 30 years, however it longs. It depends on the size of the loan, doesn't it? Let's say, let's be aggressive about it. So they get their money back in 10 years. And then the bank is likely to look at that and say, well, that's quite risky in this flat economy. We could invest the same amount of money on stock markets or on other financial assets, and we could get our money back within a month or less. So banks make commercial decisions about where they're going to lend the money. If they've got cash assets that are being held at the bank, that allows them to lend much more money, multiples of what they've got. Plus, they can also leverage their own trades as well. But what this is showing us here is that the banks are not lending money for productive purposes to stimulate GDP. And what's interesting here is the columns, which is the amount of buybacks and the amount of dividends that are paid out. So there's a great decline in 2008, 2009, following financial crisis, and then it picks up to the point that by 2014 is that that firms were buying back their own shares and issuing dividends much higher than they were before, but they're not investing in productive capacity. Now we know that they're taking out loans because we've seen it in the face-to-face sessions. We've seen that firms are issuing corporate bonds and using the money to buy back their own shares and pay their shareholders dividends. So they are competing in the stock market more so than prior to the financial crisis, because of the fact that the productive economy is flat and declining. And I think this is an interesting graph, in that only that it just shows a nice correlation between the size of the Fed's balance sheet and the stock price of the S&P 500. Now, we're not making any assertions here as to how that's happened, but what we'd need to dig into that. But we've already seen that the stock price goes up with, or jumps up with QE. But here is that this is more of an explanatory, or it helps unpack the story a little bit more by tracking the relationship between the stock prices and the size of the central bank's balance sheet. Infer from this is that additional liquidity in the market is going towards the purchase of short-term assets, stocks and equities, in other words, along with other and it's worth pointing out, along with other financial assets, is that the amount of money that's sloshing around in the system is considerable. We've said in the lecture earlier on this morning, it's been estimated it's been somewhere in the region of about $37 trillion. That's a lot of money that's sloshing around the system, and it has to find a home somewhere. And we know that because investment's low, it's not being used on invested in productive purposes. Okay. So again, we go back to Ismail's work, and what Ismail has done here is he's plotted share buybacks in the first column, what's interesting here is how it's being financed. Is that up to 2007, firms were using free cash flow to buy back their own shares and to pay dividends. But by 2000, but from 2008, 2009, beg your pardon, onwards, is that you can see by looking at the column at the end there in terms of bond issuances, is that a lot of these share buybacks are being financed by firms issuing their own bonds. So they're issuing bonds onto the market. Returns or expected yields are low because interest rates are low. Firms, particularly large giant firms, are very highly credit rated, meaning that they can issue bonds very cheaply, and then they're using the proceeds from the bond issuances to buy back their own stocks and pay dividends. And it's worth me pointing out that in that period that's being shown there, is that from 2003 to 2014, almost 97% of all US firms' profits were used to buy back their own shares or pay dividends, which is, means that there's only 3% of all US profits are actually being used in terms of R&D and development and investment in productive purposes. What's also interesting here is the amount of mergers and acquisitions. Now, why are mergers and acquisitions interesting? Well, mergers and acquisitions have quite an impact upon share price. Is that when there is an announcement of a merger or an acquisition, is that broadly speaking, is that you see that share prices go up. Why? Well, markets like mergers and acquisitions because it's an indication that the firm will trade more efficiently. Because once two firms merge together, there's usually some cost savings, some layoffs, and so on and so forth. And that is an indication that firms are becoming more efficient and they get rewarded by stock gains in the stock markets. And this is despite the fact that probably only 15% of all mergers and acquisitions return any kind of real economic value. Most of them are poor in that respect. What we've said is that QE has achieved a portfolio reallocation, that investors have switched from low yield bonds into the stock market. They get much higher returns out of the stock market in a much shorter space of time. And this in itself encourages mergers and acquisitions for financialized firms. Stock markets reward high premium M&As, but punish the long-term capital investments into R&D, productive purposes, and so on and so forth. And from a peak in 2007 of mergers and acquisitions of some $4 trillion, would that be right? $4 trillion, is that there's a plunge in by 2012, but by 2015 is that mergers and acquisitions have dramatically gone above their high point in 2007. And it's worth pointing out is that the level of mergers and acquisitions have continued at that high peak from 2015 up to current period, and the bulk of which are occurring in the US. So what we've seen is that QE creates a huge amount of liquidity into the banking system, the financial system. Banks, by and large, are not lending out credit. They're holding on to cash, possibly by ways so that they can meet their reserve requirements that are being re-established or have been increased as a consequence of the global financial crisis. QE creates a huge amount of liquidity. Banks are not lending it, but firms are recognizing that they can access cheaper forms of financing capital. So they're issuing bonds and their own proprietary ways of raising money, and that they're using that money, broadly speaking, to buy back their own shares, pay dividends, and in mergers and acquisitions. Okay, so this brings us to this statement here by the Bank of International Settlement. And the Bank of International Settlement says that the central bank unconventional policies in the US, UK, and the Eurozone have created new instabilities in markets and poor distribution and allocation of money within a financialized global economy. And currently is that the political environment in the US and the UK started to question the effectiveness of central bank policies, particularly in the US and particularly Donald Trump. I mean, I think that he was questioning the effectiveness of central bank policies as the basis on the basis of the fact that the Fed was starting to tighten. He wanted them to carry on, which you understand as a business person, as because money is cheap. We've now learned that he owes quite a lot of money. If the price of money goes up, then, or if the price of his debts go up, then he's going to have to pay out more. But also, it's having a particularly a positive impact upon stock markets. And one of the things that we know is that Trump continually talked up the stock market as an indicator of the success of his own economic policy, despite obvious and clear empirical fact that investment was slow, or was actually low in comparison to where it was between 2007. But there's a questioning of the efficacy of monetary policy, not just by the politicians, I think also by the banking community themselves, because this statement here from the Bank of International Settlement says that the risk is that over time monetary policy loses traction while its side effects proliferate. These side effects are well known. Policy may help postpone balance sheet readjustments, encouraging the evergreening of bad debts, for instance. I mean, basically is that unproductive or inefficient firms can borrow money, which and instead of them going out of business, which is what the theory suggests that they ought to do, because they're inefficient, is that they're just being allowed to carry on just by increasing the amount of debt that they've got on their balance sheet. It says also that they actually damage the profitability and financial strength of institutions by compressing interest margins, and that will be as a consequence of there being very little spread between the margins that one pays to savers and one pays to lenders. Okay, so they can't, broadly speaking, it's indicating that they can't afford anything to pay out anymore. And then it says, and I think that this is quite an interesting statement, it may favour the wrong forms of risk-taking and generate unwelcome spillovers to other economies. And what we've seen here in this particular presentation is that the wrong form of risk-taking that we're talking about is about the buying back of shares, paying dividends and mergers and acquisitions, as opposed to investing in the long-term health of the organisation. And as we go further down, it says, tellingly, growth has disappointed even as financial markets have roared. And then this is the big, or the kind of like the big crescendo, the big final statement is the transmission chain seems to be badly impaired. Now, my argument here is that the transmission chain is not badly impaired, is that the transmission chain has been theorized incorrectly, in that what they are suggesting is that reserves and liquidity stimulates lending. But what we've already seen is that banks lend to customers that will pay them back. So that suggests that they've got the transmission chain the wrong way around. The activity of the bank generates the reserves. The reserves does not generate the activity of the bank. Now, so unsurprisingly, this has been known for quite a long time, and that I've put a paper for you to read should you be interested, by Alan Holmes from the Federal Reserve. He wrote in 1969 that said that reserves do not stimulate bank activity. It's the other way around. But monetary policy, interest rate policy, is based upon the fact that reserves, or the activities of the central bank, stimulates the economy, and they're underrepresenting the importance of commercial banks. Just to say is that the stuff on quantitative easing is quite technical and quite difficult. You don't really need to know that. What you do need to know is that quantitative easing is an attempt by the central bank, once interest rate policy has been shown to be ineffective, of stimulating liquidity and stimulate liquidity and reserves, which through the transmission chain should stimulate economic activity. That's all you need to know about it. You don't need to know the various ways in which the various central banks went about doing it, because it's quite technical and it's quite complicated, and it contains an awful lot of acronyms. But if you are interested, I've also put a paper on the reading list as well that you can look at, and you can work your way through it. And it's probably about as non-technical as you're going to get, but it's still a bit of a trauma, and I wouldn't blame any of you if you didn't want to look at it. But I do know that there are a few of you out there that are interested, so that paper's there for you. All right. Speak soon. Bye-bye.